Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is a really timely conversation. Nisha Patel, we get a huge response when she's on with Parametric. Thrilled that she could join us here on taking advantage of tax-free bonds. Not one, but two people in the last week have pounded the table on your world. They're saying basically it's never been like this.
Yeah.
Is it never been like this in the muni bond world?
In the long end of the curve, so if you look at 20-year high quality AAA bond yields, we have not seen these yields sustainably this high in the past, I would say 15 years or so. So, and here's the thing, as we talk about New York City, you do see, headline stories around New York City, possibly credit. We can certainly discuss the budget bill and federal funding cuts to issuers. But my main line here is not much has changed from a credit quality perspective, right? So you're still looking at a very high quality asset class that purely based on technicals, a lot of issuance in a short period of time, not as much demand, has really created this imbalance. And long end muni yields are up anywhere from 80 to 90 basis points year to date. So you're looking at tax equivalent yields for New York, for New York residents, anywhere around 8.5% to 9% north of that in that long end of the curve, right? These are bonds, finite maturity.
Give us an example of one of those bonds. Is it the New York Mets bond of 2055?
No, I mean, you're looking at New York City Waters, right? Very high quality issuer, New York City GOs, New York City TFAs. These are just your large issuers that you're getting these types of yields for. And this is on a national basis as well. So again, what we've seen is, as you've had this big, beautiful bill proposal, do you remember earlier this year, a lot of talk around possibly removing the tax exemption or selective on muni bonds. I mean, everything was on the table. So if you're an issuer and you're looking to issue debt this year in the municipal bond market, a lot of that was pulled forward, right? You're like, let me just issue in the market now. Now, from a demand perspective, you really haven't seen a lot of inflows into the market. And that's really been the case for fixed income. It's been a little bit of a tough year, right? Choppy yields. And investors don't want to take on a lot of duration. So if you see the 10-year maturity and in, that part of the curve has been very well supported. But most high tax bracket individuals, let's say retail investors, are a little fearful of investing further out. So when you don't have that natural support and you have so much demand, this is what's created that imbalance. So we're seeing this as just a tremendous opportunity. And when you talk about those types of yields, right? I mean, compare this to any other asset class that you're looking at out there with this credit quality. It's time to leg in, simply put.
Exactly.
So, yes.
The best performance, I'm looking at my IN Go function on the Bloomberg terminal, the best performance in fixed income has been U.S. corporate high yield.
Yes.
That kind of surprised me a little bit.
Yeah.
What do you see in the high yield market?
Yeah, I mean, look, spreads have remained incredibly tight. And a lot of this is based upon the fact that, and I think a lot of your guests here have spoken about the resiliency of the economy, right? I mean, we just haven't seen any cracks in the economic data yet. We're expecting the Fed to stay on hold. And so you've seen, again, a technical story there as well, just an incredible amount of demand, which has caused spreads to remain tight. And now if you're on IN, you look at what your broad muni index has done.
Right.
Yep.
I mean, it's underperformed everything else.
If we have a debt and a deficit, and we're debating whether Mr. Besant's going to give us more T-bills than imaginable, like back to biblical times,
yes,
or whatever, the phrase I use is an amateur is crowding out. Is the federal government full faith and credit? There's so much stuff because of the debt and the deficit that they're crowding out Nisha Patel's world?
Look, this is going to have an impact on yields. There's no doubt about it. So, I'm not here to say that we're going to have your long end yields, fall tremendously here. I think the debts and deficit story is going to keep yields relatively elevated, have a steeper yield curve. But I think in short, when you talk about additional debt issuance. Where that happens on the curve is a big part of this story, right? We're talking about a lot of T-bill issuance. So if you take a look at that in terms of the impact to the market, and you take a look at the assets that are sitting in money market funds, I mean, this is a story where you could see that easily being absorbed in the market. So as it relates to munis, you know, you're seeing certainly some impact in terms of what Treasury yields have done on munis, but even more to a wider effect in the long end, which is what's presenting this opportunity.
What do you expect our Fed to do for the remainder of the year? I mean, I guess if I look at the WIRP function on the Bloomberg terminal, it's just maybe two cuts.
Yeah.
Is that kind of where you think it's going to be? Is that where they should be?
Yeah, I mean, look, I think 2 cuts are still plausible, and I'm thinking, look, we can be in a scenario of where we were end of 23. So end of 23, we had a sharp rally at the end of the year.
Yep.
We had softening economic data. We had a Fed pivot. And so, look, no one's expecting the Fed to do anything tomorrow.
Okay.
But the main story being, we haven't given it enough time, right? We haven't maybe given it enough time for any of the cracks to possibly show up. So if you do start seeing any softening in the labor market Friday, I will say it again, as you've been saying today, big day, big jobs number. But so will the month after, and so will the a month after that. So I think the Fed could be in a place by late fall, to start cutting. And I think that narrative could be, one cut, talking about it, could be that pivot that could possibly send yields, certainly a little bit lower than where we are today, no doubt about it.
Is there a demand? I mean, if I got a 7% net clean, 8% net clean, 9% triple, is it formal tax free in New York?
I don't know.
I don't even know.
You're paying all
but
kinds of
is there a
taxes.
demand? I mean, within the street, is it retail demand?
There is. So we have started to see demand pick up, I would say, I don't want to say very substantially, but we're starting to see, certainly investors picking their heads up and thinking, look, I can lock in this type of yield. You can hold it to maturity, right? You can let it roll down. Again, beautiful thing about bonds, there's a finite maturity. Outside of credit issue, which is what a professional manager is paid to do, this is a tremendous opportunity. So I think as we, again, go into the fall, possibly with the narrative that, look, the Fed could start cutting, how do I lock in yields, right? Mm-hmm. And the last thing I'll kind of say here is, like, for fixed income investors, it's been a frustrating few years. I mean, as you all know, we are now sitting at yields where if you have a starting yield of 4 or 5%, this is going to be a big driver of forward performance, right? So that's also the huge catalyst here. On top of that, you have a pretty high cushion should rates move even further from here. Right. So you can, weather 100 basis point move in many cases before you're even flat
just
in terms of return.
Coupon.
Exactly.
Right. Nisha, thank you so much. Nisha Patel, Parametric.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Neil Dutta is an optimist, and maybe on this day, this is the best day in history to speak to Neil Dutta of Renaissance Macro about the optimism of this nation. Neil, you've been writing on the tariff dynamic and how they are changeable as well. How will tariffs change our listeners, our viewers?
Well, hi, Tom. How are you? To me, the way I'm looking at tariffs is really it's a rotation of growth, right? I mean, over time, we should see more activity going into our manufacturing sector, but that'll come at the expense of other sectors of the economy. So, to me, it's not so much good or bad. I'm just looking at it, from my seat, which is it's rotating growth into some industries and away from other industries. So as an investor, you should probably proceed accordingly. But tariffs are going to be meant at some level to boost manufacturing activity. I think that'll show up for producers, and that'll come at the expense of consumption. Remember, tariffs are a consumption tax. An inefficient consumption tax, but a consumption tax.
And Paul, in Neil's note, he talked. It's a VAT. I mean, basically, it's hidden VAT tax as well that they use in Europe.
So, Neil, I mean, is this net? Can we, at this stage, maybe it's too early, say whether this is going to be a net positive, a net negative for this economy? Because this is an economy that's based upon 70% consumption.
Well, if you look at most models of the economy, sort of workhorse macro models, they'll say that it's net negative, that there's a persistent loss of output over a longer term period. But this is also sort of, I guess, to some extent what people voted for. I mean, they want more growth sourced domestically, and tariffs are one way to achieve that goal. But what I was trying to get at with what I wrote is, all I'm saying is this: if you had told me that the effective tariff rate based on how much customs was collecting would be close to, let's say 10, 15% by the summer, we wouldn't really see other nations retaliate. Stocks would be at records, and inflation would generally be coming in better than expected. I probably wouldn't have believed you, but that's kind of what's happened. Now, that doesn't mean that we're out of the woods. I mean, as you know, I'm still cautious on the economic outlook, but I mean, that it is what it is, right? I mean, if you had told someone that even though the effective tariff rate has gone up over 10 percentage points, that stocks would still be at records, I don't think most people would have believed you, but that's exactly what's happened. It's almost as if the uncertainty around the tariffs going away is more important than the tariffs themselves.
Right. Neil Dutta with us here with RenMac. Neil, I'm going to throw the 8:30 data at you. I know you haven't had time to digest it. I'm just going to give broad strokes here, folks. The advanced goods trade balance was not worser. The survey was negative 98, and it came in at a much better negative 86. The advanced goods imports cratered. That's the economic word that Neil Dutta would use. We saw month over month plunge of, I guess, stuff coming into the country. Neil, in a general statement, help us with that. Do you have a clue what the 3-month moving average is of our trade dynamics?
I mean, I haven't looked at that yet, Tom. I mean, it's 8:31. You just gave me some 8:30 numbers. But what I will say is, look, I mean, in business economics, I tend to tune out what goes on with the trade deficit and inventories. I know that's kind of surprising to hear, but ultimately what you want to look at is domestic demand. Obviously, the fact that imports are declining, I mean, that's going to show up somewhere else. Maybe it means less inventory stocking. Maybe it means less consumption. But ultimately, the decline in imports, will show up in some other area of GDP. The fact that exports continue to weaken, suggests that, the trade war might be having consequences for our, major trading partners, and is sapping growth over there, which means that if they're not growing as robustly as they had been, we can't export as much to them. Well, so go ahead.
Is a general statement, let's pick on Europe, we could pick on any other region. If Europe is slower, do we become slower?
All else equal, probably, yes.
Neil, when you think about these tariffs, is it a one-time kind of jolt to prices, or is it something and that we can lap and we can put it in our rearview mirrors? It's something different, something more longer term.
Well, I mean, I think it's a one-time shock to the price level. I don't think it necessarily increases inflation, which is a general increase in the level of prices across the economy. I mean, what we've seen so far with tariffs is goods prices have gone up, as you'd expect, for things like, furniture, household furnishings, tools, garden equipment, things like that. But prices for services have kept going down because the nominal anchor hasn't changed. I mean, John Cochran, University of Chicago, has talked about this really well. I mean, basically, if you don't change the nominal anchor, tariffs represent a relative shifting of prices. It doesn't increase the general level of prices. Yeah. And that's what we're seeing. right? Like, so the fact that nominal income has generally been slowing, households don't have the capacity to absorb higher prices across the economy. So if goods producers are absorbing some of the cost, which they are, and passing on some of the cost to the consumer, people start paying more for goods.
Yeah.
That means they have less money to spend elsewhere, and that ultimately forces the prices for those other areas down. It doesn't mean that it's good. It doesn't mean that it's a good thing. But that's kind of where I'm at right now. It's ultimately about the nominal anchor and the fact that, and Governor Waller, as you know, has been talking about this quite a bit. And that's why you're not seeing overall inflation rates accelerate despite tariffs.
Neil, thank you. Brilliant note. I can't say enough about what he says there, folks, of a disinflationary tendency of China, of Europe, and potentially of America.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We have the absolute perfect guest this morning to give you perspective across the nation on the geography of this horrific event. We'll talk to Tchir here about the market, about all the news flow, and of course a bull market with futures, frankly, this morning up 18. The VIX, Paul, under 15. I didn't notice that.
Yeah, exactly.
I think it's a bull market. And part of that, Tchir, I was with someone from the Midwest this week and a family member, and I was trying to explain the resurgent New York, and I was standing outside the glory of the new Waldorf Astoria. As you look from the Waldorf up Park Avenue to Blackstone, the Rudin Building, and north up to 59th Street, it is finance America, isn't it?
Yeah, and it's a little bit scary what happened. It was very scary, and I think we're all going to wind up trying to rethink how security should be working, what we do. It's tragic and awful.
This commitment that we've seen to these blocks, Citadel is there. We have Blackstone with their long-term lease commitment, and across the street, the absolute miracle of what Jamie Dimon did at J.P. Morgan. Explain to our national audience why Wall Street's choosing to be midtown versus a stereotype of downtown.
I think it probably comes down to the commute for many people, whether you're coming
Grand Central Station
Grand Central's right there, and it's getting easier and easier to come into Penn Station. So I think you want to be in this area.
We'll have more coverage. Miles Miller will be with us here. He is on Park Avenue this morning. Peter, this bull market on Friday, we're distant from Friday after earnings reports coming out. We get a rationalization by the bears. How did the bears get this market wrong?
I think there's been a few things. One is I do think people have been missing how powerful this, national production for national security element is. We've been talking about it for a while, and it started, I think, when the Department of Defense invested $400 million in MP 2 weeks ago and got $1 billion of debt for them. When Treasury Secretary Bessent was on with Anne Marie last Tuesday, he almost said those exact words: national production for national security. And then President Trump later in the week went on talking about the importance of AI and data centers, and that we are going to defeat regulations to make sure that we get enough electricity to those data centers. So I think that's been an uplift to this. I think the trade deal noise is more just noise. I think it's actually weighing on the market. I think people are a little bit nervous, and I think the tariff impacts will be felt over the time. But for me, it's really been this resurgence of let's build things, let's build the infrastructure. And it does tie in very nicely with the big, beautiful bill with the accelerated depreciation. I think if we can just jumpstart some of these national production for national security, whether it's in chips, AI, data centers, rare earths, critical minerals, pharma, that gets the economy going. I think that's why you've seen also it's been very few sectors that have really been driving this market, and the small caps are still kind of lagging.
Yeah, exactly. So, I mean, we're right smack in the middle of earnings, Peter. What have you learned so far in earnings? What do you expect to hear from the earnings here?
I think the biggest thing I've learned so far is if you say you're spending a lot of money on AI and chips, your stock goes up. So I think we're still in that mode that everyone is still very focused on the growth in AI, the growth in data centers, and companies that are spending on it and helping grow that benefit. So that's not going to stop, I don't think, anytime soon.
Is there, we're sitting here 22 times earnings. I mean, when do we, I guess valuations have not been a problem for this market for the longest time. Is that still the case? How do we think about valuation in this market? I'm not comfortable paying 22 times, 23 times earnings?
I'm with you, and that's why I've been looking at the things that I think really have the upside are things that are still trading a little bit cheap that can benefit from this real, the logistics, the industrial base kind of growing. I feel there's still value there.
Got it. And so I guess the question is, what do we need to see from earnings here? Do we need earnings growth to accelerate from here to support this market? Or if earnings stay right where we are, we don't have any disappointments, that's good enough?
I think, again, it's going to come down to those handful of companies. I keep looking at the Russell 2000. What I want to say is I would love to be able to say, let's buy small caps. And the problem I hear, and we're out there talking to companies, I think it's small and mid-sized companies are still much more affected by tariffs than the large cap. They've had the ability to front run things. They've had the ability to, buy up, they've got the working capital. And the flip side of it has been, the president wants countries to buy things from the U.S. Well, the three things they can buy is energy, airplanes, and chips. So that's going to continue to do well, I think.
This morning, Peter Tchir with us with Academy here as we welcome all of you across the nation. It is a shaken New York City. We'll have continuing coverage of the tragedy on Park Avenue last night. John Tucker leading our coverage with Michael Barr. Miles Miller with us on the scene with a wonderful article in Bloomberg today, a complete story of this horror. Miles Miller with us later. Peter Tchir, one of the feelings I'm getting, and it's percolating, and maybe we need to get to the weekend to get it, is what we've got is all-American Trumpian stimulus, and there's a horizon out past the stimulus where the stimulus ends, somewhat like the pandemic. Do you worry that there's a point where Trumpian stimulus, Trumpian deregulation ends?
Yeah, and I think on the tariffs right now, there's a lot of people doing a victory lap. Oh, tariffs are okay, 15% is fine. And I think the reality is we get the benefits from the tariff revenue right away. So we're seeing that hitting the deficit. I think it's just going to take time for the tariff impact. I've always thought it's going to take time. Let's say you turn your inventory over twice a year. You're probably 5 to 6 months before your full inventory has been tariffed. So I think it's going to be a slow decline in either corporate earnings or we're going to see a bit of inflation pressure. So I think there is damage being done to the economy through tariff. It's just taking longer. And I think that's all going to not tumble, but it's going to start impacting things. Right. And I don't think the job market's that healthy. And again, I keep coming back to small and mid-sized companies as the engine of growth. Yep. Are they benefiting or being hurt by tariffs? I think they're net being hurt.
In the wall of economic data today, what matters to get to Friday? Friday at 8:35. Where are we going to be, Peter?
I want to look at the quits rate. I think that the JOLTS quit rate to me is still one of the more useful pieces of information because it's almost crowdsourced, right? People can tell how good their job situation is or not. That quits rate has been fairly low. And if that continues low, it tells me there's still a lot of uncertainty.
Let's go to the Peter Tchir world. I mean, we can just, what you don't know, folks, is Peter Tchir has this whole sidecar industry of looking at the technology of America. Is our jobs report, our quits rate, all this other fancy pants stuff, is it AI affected now? All those gloomy articles, AI is going to take away John Tucker's job?
Yeah, and I'd say I see that in, I think, 3 different ways. One is the birth-death model, kind of to get wonky, unfortunately, it's saying that new companies are being formed. I think that occurs now when people get worried about their jobs and start thinking about a gig economy and apply to get an EIN or employment identification number. You're seeing law school applications skyrocket, which to me is always like, I got nothing else to do.
Right.
And what's really starting to get nervous is the unemployment rate for recent college grads is creeping higher. And to me, that seems the most likely area to be affected by this AI is, well, maybe we don't need 4 people doing DEX, we just need 1 or 2. Yep. You're not going to hand AI real decision making, but you might try and see if you can get rid of some of the junior employees. And I think that could be really detrimental to the economy over time if you lose that group of people and they're starting, paths to careers.
Given all that background, Peter, what's our Federal Reserve thinking these days, do you think?
I think they're still very focused on inflation. I think they take the jobs data, the non-farm payroll establishment headline as having been good. They look at the unemployment rate. I think they're, on hold. I think they should be cutting more. I think they should be honestly, they should have cut now. I think it's probably hard because they're getting so much pressure. I'm still looking for 3 cuts this year. I think the economy is going to be just weak enough on the jobs front that they have to cut.
Bloomberg surveillance folks with us, railroad analyst Peter Tchir. Remember, did you read early Graham Dodd Cottle? Folks, Graham Dodd Cottle's a bio, and they've rewritten it. But remember, the first two editions were all about railroad stocks, because that was America.
I spent some misguided, teenage years playing Railroad Tycoon on the computer back in the day. So I think it's just always a fascinating industry. And I do have to say one thing that I don't think I've ever said here before. In your fixed income portfolio, I think you're supposed to be heavily weighted munis. One of the little lost stories, as we're talking all about this, is munis are trading almost on top of taxables.
Yeah.
So if you can afford, if you have some money, I take money out of money markets, put it in long-dated munis. I think that trade will actually be really good for income and total return.
Nisha Patel with us later on in the show. She's expert on muni bonds. So I got Norfolk Southern. Paul, what is it? $2 billion plus trade. The termination fee is billions of dollars.
I mean, the regulatory, this is going to be 2 years.
Well, that's where I want to go. But let me frame it out, folks. No revenue growth. I mean, they haven't had it. It's not happening since 2022. There is some profit. I'll give them that. And cash flow's not all that moldy. I guess it's old line trading at a pretty rich multiple. It's not trading like Ford or GM. They couldn't do this in a Biden administration, Peter.
I think that's spot on. I think this will be a good test for the Trump administration, what we've been hoping for, right? Deregulation. This is something Trump is so expert at in his dealing with real estate and stuff. He likes deregulation. This gives him an opportunity. And there's so much that could be done in the railroad industry in and around New York City, let alone where you have all these different things. So I think this is really an interesting test. If you can push it through, that's exciting for the economy as a whole.
Peter, thank you so much. And particularly thank you so much for your comments on Park Avenue in Manhattan here at the beginning. Mr. Tchir is with Academy Securities.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Christy Akulian, Saint with BlackRock, as we had to talk railroads there for a minute. She's had an iShares investment strategy, but what it amounts to is tackling the ETF event for BlackRock to institutional clients. Christy, I think you're maybe more qualified in the trenches than anyone I know. Where are ETFs in 5 years? Did they take over the world?
Thanks for having me. It's nice to be here this morning. I heard some of the comments earlier from Barry as well about kind of the ETFization of the world. I think that, we are certainly seeing ETFs continue to grow. I think there's some very notable changes, though, in what we've seen in just the last few years as well.
Give us the big change. Give us the big change.
Yeah. So one of the biggest ones that we see is really just the adoption of active management inside the ETF wrapper. So for the first time ever, there's actually more active ETFs listed in the U.S. than there are index ones. There's certainly still more assets in the index ones, but really we've seen this sea change in terms of launches being much more gravitating towards the active side. So, we think that there's a huge amount of advantage, especially in something like some of these rotational strategies that you'll see from us too. So the ability to put even high turnover strategies, active management inside an ETF can give you that tax benefit of the ETF while still being able to stay really nimble in an environment like this. So something like DYNF, that's our BlackRock factor rotation ETF. It is our largest active ETF at BlackRock, and it does just that.
Hey, Christy, my first knowledge and understanding of ETFs was lower cost vis-a-vis the alternative being a mutual fund, because in large part it was passive. I didn't have to pay for research analysts and all this kind of stuff. Now the active, as you were just mentioning, is a real big source of growth. How does an active ETF, from a cost perspective, stack up to a mutual fund?
Yeah, so we're still seeing the lower cost preference for ETFs is still true. So typically, if you look at the cost profile of an active ETF versus an active mutual fund, you're still going to get quite a bit of cost savings. So it's somewhere in between sort of the index average and the active average with the mutual fund. So lower cost, also really importantly, again, for those active strategies, it's the tax benefits, I think, that matter just as much and maybe even more for the ETF structure than the mutual fund one. But I certainly don't want to suggest that, all of the growth in ETFs is coming from active management. If you look at the portfolio of 2025, if you look at flows so far and where investors are choosing to allocate, there's a really big difference between this year and what we've seen in previous years. The first biggest change is we're seeing a tremendous amount of flows to alternative categories. So about 8% of total ETF flows this year have gone to alternative categories. If you're worried about debt and deficits, you're probably thinking about gold and Bitcoin. And if you are, you're probably thinking about IAU and IBIT, which are our funds in those spaces.
Listen to you selling it. Listen to her working it.
Nice job.
Christy, you got to go after that. You're in the timeout chair here at Surveillance. Christy, one final question. How much are people losing in the triple leveraged name the stock fund? I mean, what's the damage? Come on, it's log normal. You know this from CFA. What's the damage to triple leverage that BlackRock has seen?
Certainly. I mean, it's not a space that we play in, but certainly we see investors, who are maybe thinking of that more as a long-term play, certainly pay the price in terms of much higher fees and daily resets. So it's not something that you should think of as a perennial position in your portfolio. I think sometimes they're using it tactically.
Great. Christy, thank you so much. Next time, keep it under 18 symbols from BlackRock.
They've got everything.
She's ginormous for us. I mean, Christy Akulin, this is all about, actually, what do you do with that wall of the blinding wall?
It's unbelievable. I mean, over the last 20 years, this has been one of the most amazing developments to me in global Wall Street. Has just been the growth of ETFs.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.